Hello, it's Jonathan Wellham here of ROCKLINC Investment Partners, and I have with me Jesse Vandermeer and also Andrew Chang. And this is our first webcast, and we hope that this will be a series of webcasts that we'll be able to do on probably a quarterly basis, but we also might do them more often depending on the opportunity to pass along some information to our clients and also friends of the firm. So the purpose of the webcast will be to give you an update, to talk about a couple of our investments, and that's where Jesse and Andrew are going to be talking about some of the companies that we have in our portfolios and also companies that they're responsible for in terms of helping on the research side and keeping up with what's going on in those companies. And also provide an opportunity to answer questions that some of our clients might have, and this is a great forum to do that also. And then lastly, we're looking at having some other people come on and talk to our clients, in particular representatives of companies that we might be investing in. So we can bring on higher profile people to talk about, again, their businesses, what they're seeing, some of the opportunities that are in their particular markets. So we think this is a great time for you to learn more about what we're doing and to feel even more comfort in terms of how we're investing and approaching the challenging markets that we are obviously in. And so with that, I'm going to convert over to a presentation. And let me just point out that below this screen, if you go down to the description, you'll see a link, and that link will take you to the presentation that we're going to work through over the next number of moments. And so I'm going to convert over to that presentation for a few moments, and because of the details that I have in some of my slides, and then we're going to bring it back to our two research folks here, Jesse and Andrew, and they're going to cover off a company each. Okay, so just one moment and I'll convert over the screen for you. Okay, there we go. So this is our webcast, February 14th. We wanted to start on Valentine's Day. We can spread the investment love around here and hopefully some great returns in 2019, continue the trend that we're on. This next slide there is just a disclaimer. And as you know, we are in a highly regulated industry, and it's important that you look at that disclaimer and bring that to bear in terms of understanding what we're talking about and limitations of future projections and so on. Now, the outline of this presentation, just a quick overview of us, because some of the people on the webcast and some of you that will watch it later, I mean, most people actually will watch this webcast later. It'll be all recorded, so you can watch it at another time. We'll talk about our investment overview, investment philosophy, some of the investment challenges, the sectors of focus that we are zeroing in on. Also, just a quick performance summary. People are obviously interested. How are you doing? What's up in terms of the performance? And then Jesse and Andrew are going to look at two companies, one company each, that are significant in most of our client portfolios and companies that are illustrative of the opportunities we see in the market. And then we'll have some questions. I have some questions that have come in, and questions for both Andrew and Jesse in terms of the companies they're looking at. And you might also have some more questions that we can handle. And just to let you know, our next webcast, we're thinking ahead, be April the 11th. And so you can plan for that. Now, in terms of the ROCKLINC overview, very quickly, founded back in 2010. After I had been in the investment industry, mutual fund industry, for about 20 years before that. Our focus is on customized portfolios for approximately the 100 families that we look after in terms of our business. We want to make sure that we're investing in an independent way. We're not just following the crowd. We want to make sure that we are differentiating ourselves in a very crowded marketplace where at the end of the day, most people just do the same thing. And we want to really build a strong worldview as we approach our investments. There's the org chart. Some of our clients have seen this already, and it gives you a good flavor of our structure of our company. So I'll just leave it at that in the interest of time. And we have very strong corporate partners for some of our newer investors and also colleagues that might be watching this webcast. It's very important for us to be associated with leaders in accounting and also the legal profession. Our investment philosophy is back to basics, invest like a business person. So we look for excellent companies. That means high returns on equity, which is what ROE stands for. Strong balance sheets. This is very important given the markets that we're in with such a load of debt out there in the global economy. Free cash flow. The business is only as good as the cash flow that it generates, and reoccurring revenue. We love businesses that have strong reoccurring revenue that's predictable and growable. Focused portfolios, we generally run 20 to 30 stocks, which is so different than the majority of our competitors who have hundreds and hundreds and maybe thousands of stocks in their portfolios if they're buying ETFs or exchange traded funds and passive investing. We believe in focus. Knowledge is power, and you can outperform that way. Long-term holding period, we like to hold businesses while they continue to grow and they remain great businesses, and that provides tax-deferred compounding, and that's very important outside of registered accounts. That's really the way most wealth is created, through business ownership over the long term and avoiding taxes until you have to pay them, which would be at the end of the process if you sell. Buy at a margin of safety and understand the economic backdrop. The investment challenges that we've highlighted over the years as we've talked to our clients, really there's four major ones. We could talk about others, but let me just mention these. And they will fit into the investments that we will be talking about in just a few moments with our research analysts. Number one, debt, and more debt. The debt out in the global economy is huge. We've got a couple of slides there to show that to you. I would suggest that the debt is at such high levels, it is going to be virtually impossible for the central banks to go back to ethical interest rates. I'll come back to that in a moment. We just heard actually yesterday, I think the US debt has now topped 22 trillion, and that's just their tradable debt. That's not, again, all of the other obligations that they have and promises. So that gets us to the second point there, unfunded government promises. The unfunded government promises are multiples of what the actual debt is. In other words, the government has promised Medicaid, Medicare, pension programs, and so on, social welfare programs that are off the charts. And that becomes an issue, as we see in the third issue there, with demographics. As populations age and more people go into retirement, and the government has promised them more and more, and you don't have the tax base to be able to support those promises, you've got a big issue. I've just put in here a massive aging population, and also the rejection of the biblical model of marriage. And what I mean by that is that if you don't have a strong marriage based upon a male and a female running a home, if that breaks down to the extent that we've seen in our society and around the world, there's never a time in history that ends well, and you're going to have serious and devastating impact on the society, the social fabric, the next generation, the young people, and so on. So you need strong marriages and families if you're going to have good demographics and a productive next generation, if you will. And then fourth, monetary policies. We've just gone through a period, and in fact, it still continues to a certain degree, of massive money printing and record low interest rates. And so the tension, which we saw late last year, is can we go from quantitative easing, which is printing money and bringing interest rates down to zero? Can we go from that condition, which is very artificial and unhealthy, to tightening interest rates and reducing the money that had been printed, pulling it back out of the system? The markets in the last quarter of 2018 told us no. The Federal Reserve was doing this, and we know what happened in the markets. The stock markets dropped by 20% plus in many cases. So just on the next couple of slides, just really to fill in a little bit about what I've already mentioned, those four factors. Here's the growth in debt. And in the black or the dark blue, that would be 1997, and then 2007 and 2017. So you have these 10-year increments. You can see the debt was 70 trillion globally, 162 trillion 10 years later in 07. And now actually It's higher than 233. That was back in 2017. The global debt now is estimated in excess of $250 trillion. It is growing at quite the pace, certainly much faster than the economic growth, and also much faster than what normal interest rates could possibly support. So, we've got this big problem, too much debt, and interest rates have to be really low to keep it going, which means it's going to be really hard to get rates up. The pension gap, I won't belabor this other than to say right now the pension shortfall, according to the World Economic Forum a few years ago, was about 70 trillion. And by 2050, by their estimates, you're looking at about a $400 trillion deficit. And what I point that out to you is because basically it just shows that these pension obligations are off the charts and they are not going to be realized. I mean, we're not going to get to 400 trillion because there's going to be a breakdown in the system long before we get there. And there's going to have to be some rethinking of all of these promises. The demographics, this just shows that if you do average 1.2 children per woman, which is now becoming largely the average across most of the industrialized world, you go from 100 individuals, and in 4 generational terms, you're down into the teens. You're down to around 16 to 18 people. So if you want to run a culture and society on 1.2 children per woman, you have to be prepared for massive population shrinkage. And the country that's leading the charge right now in that area would be Japan, and China following on their heels. And so we're going to see just massive changes across the world, and that also is going to have an impact, again, where you're investing. This slide here just highlights really what's happened with the central banks. The chart, as you see this going up, that just talks about all the money that's been printed. So don't worry about the colors, just look at the increase in the size of the number of assets. And this is just the central bank in the United States. As I point out on the top of this slide, world central banks added about $20 trillion to the global system over the last 10 years. That's crazy. And it means that we have to be careful about why things look as good as they do, if they in fact do. We want to be very careful in terms of the investments we're buying, because so much money has been artificially pumped into the system. And what we're saying is it's going to be virtually impossible to get that money out. The addiction is well entrenched. People need liquidity and they need the money. So what are the key implications that we see? And there's so many, but let me just say a couple of things here. First of all, it will be virtually impossible to end money printing and reduce the balance sheets of the major central banks without a recession. When we talk about reducing the balance sheets of the major central banks, we're talking about pulling the printed money back out of the system. And we're saying that the system is so addicted, the interest rate, the debt, I should say, is so high that to pull that liquidity out and to raise rates materially will be virtually impossible. The second point there is impossible to raise interest rates back to an ethical normality. What do I mean by that? And when I look at the monetary system that we have slid into, or that has been developed over the last 40 years plus, it's really quite an immoral system when you think about the fact that right now you cannot buy an interest-bearing security that holds its purchasing power after inflation and taxes. Number one, you can hardly buy, if you buy a 3% bond and inflation is 2%, you might argue even higher, and you're paying 50% tax rate on your interest, you're not even holding your purchasing power on that basis alone. When you add the fact that if you're buying a bond, there's a risk to that bond because you're buying either a government bond or a company bond where it could be a problem and you could run into a diminution in the value of that bond, and you're not being rewarded for the time value, the fact that you're tying your money up in a fixed income security for an extended period. So when you think about that, what kind of system takes you to the point where your money, even when you buy a bond, is not protecting your purchasing power and certainly not rewarding you for the risk of the investment that you're going into, and has no respect for the time value of money? And so when you see that, you again want to be very cautious and very careful, that we've taken this monetary conditions really to an extreme level, and that means we should expect volatility, and we want to be careful about the assets we're buying. Basically, what does that mean? Favor hard tangible assets. We want to buy things that are hard assets, things that are going to be essential, scarce. They have proven business models that will have staying power as we work through some of these challenges with the excessive debt and very faulty monetary models that we've embarked on over the last couple of decades. We want to maintain a healthy exposure to monetary substitutes, such as gold and silver, and have firepower to take advantage of market volatility, which is what we're focusing on. We've talked to our clients about the 8 areas that we focus on, and I'm only going to just mention these. I'm not going to go into any details. We've done videos and presentations highlighting these areas before, but infrastructure, certain areas within financial, we were careful about leveraged financials. Technology is a wonderful long-term area. Manufacturing, one of the companies that Andrew's going to highlight this morning will be a manufacturing company, Honeywell. Precious metals, we've talked about monetary substitutes, gold, silver. It's very important, if you're going to protect your purchasing power, have a hedge against the monetary folly we're surrounded by. And Jesse's going to highlight one of our companies in that space. Healthcare, no question, with an aging demographics. Agriculture, everybody has to eat, and there's all sorts of challenges in that space, and there's some businesses that are very profitable that we like. And good old water, the most important commodity on earth, I guess, along with air, water and air. You don't go very long without either of those. And water is probably the most underpriced commodity, and there's some good opportunities in that space. Just in terms of just quick performance, overall, you can see that our book of business, that's what we call it, sort of a balanced fund, if you will. That's our book of business, which means it's a compilation of all of our private clients' segregated accounts. And that's about 62% equity, 38% bonds. So it's not all equities. You can see the returns there. That's after all fees. And once you get to 2 years, that's an annual compound rate of return. That's important to point out. It's not a simple rate of return. It's an annual compound rate of return. So, for example, if you take the 3-year return, that means we've been generating after fees 7.7% per year for clients. And then this slide here, which will be the last one before I hand it over to the fellows to talk about the companies. This slide just highlights the 100% equity portion of our ROCKLINC accounts versus the TSX, the Toronto market, and the S&P 500 in US dollars. And you can see, if you just, we'll look at one spot here, 3 years, we've been averaging about 13.1%, and that's against the TSX, which is about 6.6%, and the S&P in US dollar terms, about 7%. And over the last year, you can see, this is as of the end of January, you can see the TSX was actually negative and the S&P was negative also. Now we're bouncing back quite a bit, and so hopefully those numbers will become more positive going forward. So I'm going to hand it over to, we're going to talk a little bit about the precious metals companies, and I would encourage you to look at these slides. I'm going to knock off the sharing right now, so you'll be able to just see us, and I'm going to hand it over to Jesse Vandermeer. There we go. I'm going to hand it over to Jesse, who works in a number of the sectors with me, and in particular the precious metals area, and he's going to talk about Sandstorm Gold. Jesse.
Like Jonathan mentioned, the first company we'll talk about is Sandstorm. Sandstorm and its peer companies they're involved in alternative lending to the mining industry, and they operate using royalties and streams. A royalty involves a company like Sandstorm providing an upfront payment to a miner in exchange for the right to receive a fixed percentage of the revenue derived from the production of that mine. A stream also involves an upfront payment made by Sandstorm to a miner, and that's in exchange for the right for Sandstorm to pay a fixed amount per ounce of gold from that mine. Sandstorm then captures the difference between the current spot price of gold, which is around $1,300 an ounce, and that fixed amount agreed on in the contract, which is usually less than half of the current spot price of gold. So, for example, it could be between $1,300 and $450, and Sandstorm captures that margin there. Why do we like these businesses? Why do we find them attractive? Well, firstly, these businesses are cash flow generating machines, and they are supported by a highly scalable business model. So these cash flow generating machines means that they can take that cash and reinvest it and compound it. And we know that's one of the best ways to produce wealth. Because of this high cash flow generation, that also means that these businesses often carry very little debt to no debt on their balance sheets. And that also reduces the risk of the business. Secondly, another reason why we like these businesses is that there's structural shifts that's actually moving capital that has traditionally been in the sector out of it. And this provides an opportunity for a company like Sandstorm to step in and grow its business and its portfolio. We won't get into the reasons today of these structural shifts, except to say that some involve technology disruption. The traditional role of brokers and bankers are changing. And also there's a huge shift from active to passive investing, which means the traditional capital, equity capital pool that these miners can tap is shrinking. So this is great news for Sandstorm and its royalty peers because they can provide this capital to these miners. Thirdly, as Jonathan highlighted earlier in the presentation, we face unprecedented challenges with regard to our monetary backdrop, unfunded liabilities, off-balance sheet liabilities. And this is an environment where we would like to hold precious metals for sure. There's unprecedented monetary experiments, and this bodes well for the precious metal prices over the coming years and decades. And then lastly, the last reason, among many, of why we like these businesses is that there's large upside optionality from both the price and mine expansion without the downside risk of operations. With regards to mine expansion, these high quality mines often include, there'll be discoveries on these properties, and Sandstorm, via its arrangements and contracts and its royalties and streams, they're entitled to this extra discovery on these properties without having to pay extra cash. So these discoveries and the cash flow from these discoveries actually flow right to their bottom line. With regards to the operational risk, Sandstorm does not actually operate the mines, and this shelters them and mitigates them against operational risk that is prevalent in the mining industry. So this often includes cost overruns or idiosyncratic events that often occur at mines, such as natural disasters and so on. So actually, Sandstorm's margins can fully benefit from a rising precious metal environment without having a huge risk to their margins, which would be the case in typical operators. Moving on to the next slide, I'll talk about Sandstorm more specifically as a company. It's based in Vancouver and has a portfolio over 200 royalties and streams. Currently has 20 production stage assets, 23 development stage assets, and over 100 royalties and streams on exploration stage. These projects are heavily vetted by the competent management team, which is made up of industry professionals and experienced geologists. And all these projects allow Sandstorm to have a huge portfolio of growth embedded into the model. When we look at two main characteristics of Sandstorm presently versus Sandstorm 10 years ago, we see firstly that it has been increasingly diversified. Sandstorm in 2010 only had 5 royalties in its portfolio versus now of over 200. This reduces the concentration risk that one cash flow or one project could be detrimental to Sandstorm's margin. But now with over 200 royalties and streams, the portfolio reduces the concentration risk that was once present when Sandstorm first went public in the very young days. Secondly, another area I would like to highlight how Sandstorm has changed over the years is counterparty risk. Sandstorm was 100% exposed to junior miners in 2010, whereas now, currently, 75% of its counterparties are high-quality, mid-tier, or major gold companies. This is set to increase to 90% by the year 2023. In that year, 2023, Sandstorm's gold attributable production is set to double from current levels, and this is primarily a result of the Hot Modern project, which Sandstorm invested a 30% NPI, or net profit interest, a year or so ago. This is a very high quality mine located in northeastern Turkey, has about 11 years of estimated mine production or mine life, and an estimated production of around 80,000 GEOs, or gold equivalent ounces. Like I said, a very high quality mine, low cost, and it's set to deliver after tax 50% IRRs, or internal rates of return. And that's huge growth and fantastic returns for Sandstorm, and kind of sets it apart from the other players in the industry, although they also have fantastic portfolios. Lastly, in terms, again, speaking to Sandstorm's ability to generate tons of cash, Sandstorm is embarking on a 10% NCIB, so that's a normal course issuer bid, and essentially repurchasing 10% of outstanding shares, which is another way to return cash to shareholders. Again, as a testament to Sandstorm's ability to generate cash, is the board will shortly consider initiating a dividend, which speaks to Sandstorm's predictive cash flows. For all these reasons I've highlighted, this is why we like Sandstorm, we like the business model, we like the company, and we continue to add it to both the ROCKLINC Partners Fund and to client portfolios.
Thank you very much, Jesse. That's terrific. And just our clients also, if you have Franco-Nevada or Royal Gold or Wheaton Precious Metals, they also operate in a very similar business model of royalties and streamings, amazing cash flow businesses. In fact, it really goes back to the mid-90s when I was with AIC Funds and a portfolio manager there, where we built the largest position in Franco-Nevada at that time in a number of our funds. So we've been in this industry for some time. I'm going to hand it over to Andrew, and then we're going to come back to a couple of questions with Jesse at the end, but just in the interest of time, I'm going to hand it over to Andrew Cheng. And Andrew covers off a number of areas, including manufacturing, and he's going to just say a couple of things about Honeywell. So Andrew?
Automation has become an important enabler of growth across many different industries. It helps improve the efficiency and productivity of business processes and systems. One of the companies that we like in this space, as Jonathan mentioned, is Honeywell International. Honeywell is a leading pure-play industrial company that is transforming into a software industrial company. Management expects that over the next few years, over 50% of its growth is expected to come from software. Honeywell has over 22,000 engineers, and over half of those engineers are devoted to developing software solutions in the areas of data analytics, cybersecurity, and cloud computing. Now, Honeywell operates in 4 main businesses. The first business is aerospace, and this accounts for 37% of its business. Many of Honeywell's aerospace products and components can be found in aircrafts and spacecrafts. These include transportation flight systems, wheel and braking systems, auxiliary power units, and propulsion engines. We like this business because of its great macro growth trends. As the number of flight hours increase and the number of travelers internationally from China and Middle East increase, we believe this will benefit its aftermarket and demand for its products. The second business that Honeywell operates in is called Performance Materials and Technologies, and this accounts for 26% of its business. Some of its customers include petrochemical, chemical, power generation companies, and oil refining. Many of these companies have systems and facilities that are interconnected, and data is a very important commodity for these companies. And what Honeywell does is it develops automation and control software and solutions that help these systems integrate together and provide predictive data analytics to help operators better manage and operate their facilities. The third business that Honeywell operates in is building technologies, and this accounts for 22% of its business. Honeywell develops a comprehensive number of building technology automation solutions that help building operators better manage their climate control, energy usage, ventilation, and water quality. Over 10 million buildings across the world leverage Honeywell's building technologies. The last business, and which is one of the fastest growing of Honeywell's business, is safety and productivity solutions. And this accounts for 15% of its business. Safety solutions is designed to keep workers safe. So fall protection, safety equipment, protective equipment for workers. Productivity solutions is one of its fastest growing sub-business. This includes warehouse automation technology that is used in distribution and fulfillment centers. Now, there are many reasons why we like Honeywell. I would just like to address two of those reasons. The first reason is that Honeywell is a very focused company. It is very prudent and very careful at divesting and realizing value from its assets that no longer fit within the Honeywell portfolio. Within the past 3 years, Honeywell has divested 3 businesses. The first one is Advancix, and this is a fully integrated manufacturer of chemicals and resins. The second business is Garrett Motions, and this used to be Honeywell's transportation system business, and they develop diesel engines and turbocharger engines. And the last business that Honeywell has spun off is called Residual Technologies. And this used to be Honeywell's home and global distribution business. And they develop HVAC controls and fire protection solutions. The second reason why we like Honeywell is because they are a very disciplined allocator of capital, particularly within growing markets that have great potential. One of the investments that Honeywell made in 2016 was a company called Intelligrated Systems. Intelligrated develops, designs, manufactures automation technology that is used in warehouses for fulfillment centers. As e-commerce continues to explode across many different businesses and industries, we believe that Intelligrated's warehouse automation solutions will continue to grow with this trend. Honeywell has a very strong balance sheet. They have over $9 billion of cash and cash equivalents as of December 31st of last year. We believe that this gives them great firing power for share repurchases, dividends, and also key strategic investments and acquisitions. Overall, we believe that Honeywell is a strong leader within its industry. We believe that it has great financial position, differentiated technology, and an astute management team that will continue to pave the way into the future. I'll now hand this off over to Jonathan.
Yeah, Andrew, sometimes we get the question from clients in regards to automation, which is one of the things when we looked for an industry to get involved in, we wanted to tie together manufacturing and automation because everything is being automated in terms of manufacturing, warehouse, and so forth. But it's interesting, sometimes people say, well, how far along are we in the automation trend? Are we first inning, second inning, or are we in later on, maybe sixth inning? And I think what we've found, Andrew, maybe you just comment really in terms of just the massive amount of opportunities that lie before us in terms of automation.
Yeah, no, absolutely. Over the last 300 years, there have been 4 major industrial revolutions. The first one saw the mechanization of different processes. We had the steam engine. The second industrial revolution, we saw the electricity, and we saw mass production. The third industrial revolution, we saw this growth of mass computers, personal computers, and the internet. And the fourth industrial revolution that we're currently in is this mass growth of digital information. We see this within our cell phones. We see this with all different types of systems. It produces massive amounts of data. And this data can actually be leveraged for various different capabilities, such as artificial intelligence, Internet of Things, and cloud computing. And so there's a massive amount of opportunity. Honeywell has been leveraging this by using cloud computing, integrating into their systems, having systems talk together. Some of their data that they use help with predictive maintenance. So a facility might have an issue with one of its key areas, and because of predictive analytics, and that information can actually be sent to management. They can review it in real time, and then they can address that on the spot. And that helps reduce costs and improve the profit margin.
Yeah, and one of the things we see with Honeywell, just the last comment in terms of Honeywell, is that, again, that growing software component. And we see this in a number of our companies. We have another company called Xylem, which is in the water business and water infrastructure, and they're making more and more of their money on monitoring water flows and selling software systems. But software is a great business, the economics of software. Maybe just, and so Andrew, just have a couple comments in regards to that, because what you're finding is these manufacturing companies are embedding some very high profit business models now that really weren't there, say, 20 years ago. But when you can sell an automated process and it's digitized, now there's the opportunity, it has to be run by something that's software. And what are some of just a couple of the quick economic reasons why software, and we have a number of software companies, is a great business to be in terms of a shareholder?
Yeah, there are a couple reasons why software is a great business. It's low capital intensive. This allows for high free cash flow. It has high operating margins. Once software is developed, you don't have to continue to plow more capital into it. That's what gives it its high operating margins. It's also scalable. With some of the new software businesses, software as a service, it's very scalable. You can apply this software across multiple different industries and make minor tweaks or major tweaks in real time.
Yeah. Okay, so just I'm going to pull Jesse over here. We have just a quick question I'm going to ask him in regards to the precious metals area. Is if you're following this space, so far this year and even at the end of last year, there's been a lot of excitement in the precious metal space, particularly dealing with consolidation. And so we saw Barrick Gold and Rand Gold get together. We've seen Gold Corp and Newmont. I mean, these are major players, and that's because they're struggling to really make their businesses more efficient, more profitable, and it's hard to find large deposits and that are going to be economic. And so one of the questions that comes up is, what's the impact on the royalty companies? What's the impact on some of these financiers if you're getting these big M&A transactions, mergers and acquisitions are taking place? Is that going to crimp their opportunities, or is it going to enhance their opportunities? And Jesse, maybe just deal with that, because we're excited with what we're seeing.
For sure, M&A transaction and activity is fantastic for these royalty and streaming companies. Like Jonathan mentioned, these big players are merging together. They are facing declining production profiles. So they merge together, and often what will be the case is that they will divest of non-core assets. This doesn't mean that these assets are not high quality, but these big companies faced with declining margins, though they need to focus their time and resources on the mines that will really move the needle. So there'll be this opportunity for new players, strategic, financial, to buy up these, usually the case, smaller non-core mines, and they will need financing, as is the case. And players like Sandstorm, we have Wheaton Precious Metals, Franco-Nevada, they can step in and help these buyers snap up and finance these non-core assets that are being divested by these mergers between the big guys.
Okay, that's great. Okay, well, we appreciate you joining us. We wanted to try to keep it reasonably tight in terms of the presentation time. And hopefully we trust that's been helpful for you to give you a sense on what we're doing, how we're differentiating ourselves in the marketplace, some of the amazing companies that we're purchasing. We don't have any rose-colored glasses on. We want to work for every single percentage growth we can find, because we think the markets are going to be challenging, and therefore we're going to be in businesses that can weather challenges and do very well and make money for the long term. So thank you very much for joining us, whether you joined us live or you're listening to this on a rebroadcast. Send in your comments to us, and also be prepared for our next webcast, which we're planning for April the 11th. April 11th, same time. So thank you very much, and you have a great rest of the day. And in particular, enjoy a wonderful Valentine's Day. Bye now.